Due to the increased volatility and heightened interest, this week we're going to be focusing our beginner commodity series on silver. As usual, we will start with a brief fundamental overview and then get into a brief technical picture. This guide is meant to be a beginner's introduction to silver futures. If you'd like to learn more, we encourage you to do your own research to see if silver futures are right for you. What are silver futures? Silver futures are standardized contracts that allow you to buy or sell silver at a future date and price. They are a physically delivered contract used for hedging, speculation, as well as diversification. They trade on the COMEX, which is part of the CME group, MCX, which is in India, and the TOCOM, which is in Japan. What are the contract specs? There are two main contracts that are traded. One is the SI, the other is the SIL. We're going to focus on each one individually. So the ticker symbol is SI. Its contract size is 5,000 troy ounces per contract. It's quoted in US dollars per troy ounce. Its price movement is spot 005, and it moves in $25 per tick. Its trading hours are 6 p.m. to 5 p.m. Eastern Time, which is Globex. RTH hours are 8:25 a.m. Eastern Time to 1:25 p.m. Eastern Time. Settlement time is 1:25 p.m. Eastern Standard Time. Now let's move on to the SIL. So the ticker symbol is SIL. Its contract size is 1,000 troy ounces per contract, which means it is 1/5 the size of the SI contract. It's quoted in US dollars per troy ounce. It has the same price movement. The only difference is instead of it being $25 a tick, it is $5 per tick. Shares the same trading hours, same settlement time. Why trade silver futures? Leverage. Control large amounts of silver with relative small amounts of capital. Liquidity. They're very easy to enter and exit positions. Price discovery. It has transparent market pricing. Hedging. This is more for producers and commercials. Protect against price volatility for businesses. Speculation. Profit from price movements in both directions. However, due to the nature of the leverage that's involved in silver futures, leverage amplifies both profits and losses. You must be very, very careful when trading this, because if you're trading the SI contract, it's $25 a tick. And if you're trading the SIL contract, it's $5 a tick. So they are highly leveraged. What is silver's role in the global economy? Monetary investment. You have coins, ETFs, as well as silver bars. You also have the industrial demand, which accounts for roughly 55%, where silver is used in electronics, it's used in solar panels, EV, medicines, as well as water purification. Where does silver come from? Top producers: Mexico, China, Peru, Chile, Russia. Largest exporter is Mexico. Largest consumer is China. Major companies or players in the market are Glencore, KGHM, Pan American Silver, as well as Fresnillo PLC. Some factors that affect price: you have industrial demand and technological growth, interest rate and US dollar strength, inflation and market uncertainty, gold-silver ratio trends, supply constraints, and geopolitical risks. Some pros of trading silver: number one, they're highly liquid and have tight spreads. Number two, they have leverage potential for large exposure, meaning you can get really, really big and really use leverage to your advantage. But again, there is the downside that leverage does magnify losses on the downside. There is a physical delivery option, transparent global pricing, inflation and currency hedges. Some of the cons: it's highly volatile and there's potential for large losses. Leverage magnifies the risk, requires margin management knowledge. Now, this is important because silver, when it starts to get very volatile and really move around a lot, the margin requirements can change on a dime. So you really need to be aware of it and be on top of what the margin requirements are. It is sensitive to global macroeconomic trends, and then as well as storage and delivery considerations. Silver ETFs versus the futures. Futures offer leverage, ETFs do not. This is specifically speaking to the SLV ETF. Futures allow for physical delivery, ETFs only track price. Futures have margin and expirations, ETFs do not. Futures trade 23 hours a day, 5 days a week. ETFs only trade during exchange hours. Last but not least, some key takeaways, and then we'll get into a little bit of the technical picture. Silver is both industrial and monetary. The futures offer leverage and liquidity, but involve substantial risk. The two main contracts are the SI, 5,000 ounces, $25 a tick, and the SIL, 1,000 ounces, $5 a tick. Again, SIL is 1/5 the price of the SI from a tick perspective, as well as from an ounce perspective. Prices are influenced by industry, inflation, and US dollar trends. It is useful for hedging or speculation with proper risk control. Now that we had a brief overview of the fundamental drivers and some fundamental facts, let's get into a small technical picture of silver. For those of you that have been following us over the past couple of weeks, this monthly chart should not be foreign to you. We blew through every single possible resistance point and every target area that we have been focused on over the past month or so. So for those of you that have been in it long and have enjoyed this ride, congratulations. We've taken out the 2011 highs going back all the way to April of 2011. So we took that out. The April 2011 high was 49,820. Now we're at today's high, as of this writing on October 9th, 2025, is 49,965. So we took that out. Silver has been quite parabolic from a technical overview. That's just a monthly. Look at the weekly. It's very overbought. It's quite obvious. Even on the daily chart, it has been grinding. Silver does get sweepy. It's not as sweepy as gold. Gold is definitely a lot more sweepy than silver. It doesn't have that same characteristic. However, when silver does get going, it does get going relatively quickly. So you really have to be careful. It does not jump the book as much. When it does get going, it can jump the book, and you do need to account for that kind of slippage when you're trading it. When it's dead, it's dead. Right now, obviously, metals are very much in play. Coming into the end of Q3, coming into Q4, the metals markets are very much in play. Silver is rocking and rolling. Gold is rocking and rolling. Because of the fact that they're so in play, they're really all over the place. So you really have to know what you're doing. You need to trade this small. Again, as we said, the spreads are relatively tight. It is easy to trade it from a getting in and getting out perspective. It's not where you have to worry that the books are completely blown out and the spreads are completely blown out and you can get crazy slippage. That doesn't happen here. However, you do need to pay attention to the fact that because they are $25 a tick and $5 a tick, depending on the contract that you're in, you really need to know what you're in and why, because things can get ugly in a hurry if you're on the wrong side. However, with proper risk control and proper risk management, they can be traded and they can be traded successfully. With that being said, we hope you enjoyed this video, this brief overview on silver. Thanks for watching, and we'll see you on the next one.